Let's get into your markets now. Asian markets rose to a 7-month high today following the lead of other leading markets. This as market participants gain more confidence in the prospects of rate cuts by major central banks in the coming months. This expectation has resulted in lower developed market bond yields, which has seen the US dollar weaken and the local currency strengthen as a result. The Nikkei share average rose by 0.23%. The Hang Seng Index ended the session up 0.76%, while over on mainland China, the Shanghai Composite Index closed up 0.61%. Over in the United States, Wall Street charged ahead on Thursday, with the S&P 500 posting a record closing high, with biggest boosts coming from technology and growth stocks on investor optimism about prospects for rate cuts from the Fed Reserve. The S&P 500 gained 1.03%, the Nasdaq Composite gained 1.51%, and the Dow Jones Industrial Average rose by 0.34%. The JSE is trading higher today, with the all-share index 0.7% higher at 73,665 points. The Industrial 25 index is 0.3% down. Financials have added 0.5%. The rand is trading at 18 rand 64 to the dollar, 23.91 against the pound, and 20 rand 38 to the euro. And gold is trading at $2,168, platinum at $923 per ounce. The price of Brent crude oil is trading at around $82.69 a barrel. All right, to break down the markets for us, I'm joined by Tato Mashiro. He's a portfolio manager at Sanlam Private Wealth. Thanks very much, Tato. Before we get to anything, I'm absolutely shocked at the gold price. It's just hiking and hiking. What is that all about?
Well, good afternoon, Napo. I think the gold price has definitely shown some resilience, year to date, and also towards, I suppose, the end of Q4 last year. And this is, as you alluded to in your introduction, has to do with the possibility of rate cuts. So we've seen a lot of risk-on trading since November last year, when we had some dovish news coming out of the Fed. And again, earlier this week, as you pointed out, with Governor Powell stating that we'll definitely see rate cuts before the end of the year, and the Fed not being far, in his own words, from seeing continued or sustained signs of inflation coming down. So gold is obviously getting quite a strong bid. It's obviously a non-yielding asset, and with lower rates, that obviously is favorable for gold. And investors have historically looked to gold as an inflation hedge. The same could be said about Bitcoin in a digital format, rather. So those are, I suppose, plays for investors who may be a bit more skeptical on the inflation aspect, especially with lower rates. Of course, you've also mentioned, we're reaching all-time highs in some of the equity indices in the US, and that's also due to rates and more from a positive favorability perspective of higher asset prices. So different segments of investors looking at the market differently.
Yeah, but when are we going to see a broad-based increase in valuations of stocks right across the globe? Because it seems as though it's been the likes of your tech stocks which have been blowing things through the roof, and there are question marks as well about how viable this is, because how many companies, for example, are actually making money and commercializing artificial intelligence and so on and so forth. But when are we going to see a broad-based increase, less volatility in markets? Is that likely to come as a result of this perception that we're going to now see rate cuts?
Well, I don't think we really need a broad-based market rally to sustain the current market rally, as long as investors continue to believe in the secular AI theme. If we look at the US market, the large tech stocks are a considerable weight in the index. And so continued positive momentum from their side is enough to carry the entire index. Obviously, the equal weighted index hasn't performed to the same extent, and that speaks to tough conditions for the real economy and somewhat softening consumer spend in certain segments. But overall, we've got a very strong secular theme, and it's impacting the largest of the large caps, who also, it must be said, have very strong balance sheets and are quite cash generative. And so the market is overlooking the sort of concentration around this particular theme at the moment.
What about, stocks here locally on the JSE? We've heard about, foreign investors shying away, disinvesting out of the capital markets here in South Africa. But we know that the valuations are very low, and we know that South Africa has great potential if our structural reforms and everything else could, get some momentum. Do you think there are some pockets of areas where people who do have some liquidity, they should be investing so that at least when these stocks do take off, they get full advantage and they're able to make money?
Well, I think the story is quite known in terms of valuation discounts for a lot of the SA Inc. shares. There's just not enough attention being put on these counters relative to large caps. And that is unlikely to change until we start seeing more attention, one could put it, in the small and mid cap space. So obviously the large caps get most of the attention from a benchmark weighting perspective and also from a research perspective. Foreigners would come back if, as you alluded to, and it's a big if, we did see some structural economic reforms that led to meaningful uptick in GDP growth. But South Africa's growth outlook in the medium term relative to other emerging markets is just not that favorable. So it's kind of a hard sell given where it is, but valuations are attractive. They could remain attractive in the absence of further investor interest, but we'll have to wait and see what the upcoming political elections hold in terms of potential macroeconomic and fiscal policy is concerned.
Indeed. Tato, we're going to leave it there. We've run out of time. Tato Mashego, he's a portfolio manager at Sanlam Private Wealth. We're going to go for a quick break. After that, Diabo Sito will have SME on point for you.